this works as far as in phase two. First of all, what I want to do is understanding some of the terminology, because the reason I put this in here, because sometimes I'm talking language and everybody goes, what is he talking about? Okay, and I don't want you to feel that way. Secondly, you don't have to write this down. You're getting a video of this. You can write it down later, okay? So, but leverage is other people's money. Normally, that's a mortgage company. Doesn't have to be, but normally what we call OPM, other people's money, okay? Appreciation, that's the rise in property value. Depreciation is the loss in value. Now, that doesn't mean loss in price. That means when you own a rental property, IRS allows you to depreciate that property, and they say it's wearing out, okay? So it's not the loss in price, it's a loss in the actual house itself. So you make money on that. Tax bracket, this determines the amount of tax you're gonna pay. In cash flow, you got three elements. You got positive cash flow, you have negative cash flow, which nobody wants, right? Obviously, all right? And then you have what we call consistent cash flow, okay? And as I use this terminology, you'll see tonight and in future phases of the single family home strategy as far as how it works, okay? The next item here, equity, that's basically dollars that are tied up in a property that you could pull out through either a refinance or second or third mortgage. Tappable equity is indicated, that's equity you can use. Assets, that's the value of anything that you own. And the liability is what you owe on what you own. Okay, and the net worth is the value of your assets minus your liabilities. And at the end of my presentation here tonight, we're going to send you out another form. So yes, you're going to have more homework to do this weekend. So, grab a cup of coffee on Saturday morning. Okay, how the investing cycle works. Let's talk about that in brief, and then we're going to get into some other areas as well. Basically, you would either use cash, IRAs, or a second mortgage or a refinance, okay? And then next, we go out and purchase properties, which we would help you do, or you can use your own real estate agents. With buying that property, you're gonna reduce your income taxes, okay? And you're gonna start creating equity, okay? And sometimes very quickly, which you'll see here tonight. With that increases cash flow, because as the rents increase, you're gonna have more cash flow coming in. Okay, and then what happens is you just start all over again. Okay, you do another refinance, you buy another property, reduces your taxes, increases cash flow, and you just keep it going. The key to this is to not get overextended, and that's where we come into play, because we've had clients, in fact, one gentleman in particular, I think he owns 14, he wanted to buy some more, and I just told him we wouldn't sell him any more properties, and he was kind of shocked. Yeah, but the thing of it is he appreciated that, because very shortly after that conversation, his company went from doing very well to not doing very well. So he was more than appreciative that we asked him to stand down for a while before he bought any more properties. Okay, how does an IRA work? A lot of people, and I'm not going to get into the weeds, so I'm going to give you the 35,000 foot view here tonight. But basically, on an IRA, you have your IRA, okay? In some institution. To do a real estate deal, you have to have an accommodator, okay? And then you can go ahead and guide that accommodator on where to send the money, okay? And then we go out and find you a property, and then the accommodator will move that money over to buy that property, okay? But you cannot go ahead. Here's what you cannot do. You cannot find a good deal and then write a check out of your personal checking account and do a deposit on a property. The moment you do that, you negate using your IRA. So you have to have this set up in advance, so you can go ahead and make a deposit as far as on a piece of real estate. So just want to kind of give you a broad overview how that works. 1031 exchanges are great, but also the IRAs are a great way to go as well. Now, is there any questions as far as to this point? Okay.
We don't have any in the chat.
All right, we're going to go move forward here. Okay, so here's the process for tonight. Determining what you can buy based on your current assets and the number of years until you retire. Okay, that's number one. Number two, what are the different types of properties and approaches we can use to buy properties for your single family retirement. Okay. Third is how your agent and management one will analyze the property to see if it works for your retirement. And then number 4 is how do you implement the plan, set up your checking, savings, investment account so you can manage your retirement, purchases of real estate correctly. All right. So let's go to the first one, how we determine. Okay. Well, first of all, it's based on the information you provide us, like some of the information that you went ahead and filled out since the last webinar. Okay. Regarding what kind of cash you have any IRAs, you have any equity, that would be the next thing that we would go ahead and look at. Next thing of it is we need to know how many more years do you want to work until you retire? Okay. We need to know that. Okay. And then thirdly is how much are you leveraged overall financially? And we do this so we don't overextend you. And once you fill out your net worth statement, we'll be able to detect as far as how much you're leveraged overall. I'm talking about not just in real estate. I'm talking about everything from cars, furniture, everything. We want to know how far you're out there. Okay. For an example, when I was 27 years old, okay, I went into a very high leverage position, like 90%. And everybody said, you're going to lose everything. I said, I have nothing. So I didn't really have anything to lose because I had nothing. So I was willing to roll the dice, but I was single. I didn't have a family. I was 27 years old and had a lot of energy, still have a little bit of that. But the bottom line of it is I was ready to roll the dice. Now, at 67, you can't be 92% leverage because you don't have time to go around again. Okay. So that net worth is very, very important to fill out before we start doing investing for you. So we don't put you at risk. We would never want to do that. Okay. Any questions on that? Okay. We're going to keep going then. Okay. So what are the different types of properties and approaches we can use for your retirement? Okay. Well, first of all, you could do single family home. You could do condos. You could do duplex, you could do triplex, you could do townhouses, fourplexes, okay? And in any of those, one option would be to put about 30% down. That would be one option, okay? Second option, you could buy any of the same types of properties and you could put 50% down. And people say, well, why would you put 50% down? Again, it depends on how long it's going to be until you retire. And also what kind of a leverage position are you in? If you're older, you may put a little bit more down. So it's a little bit less risk and you're less leveraged. Okay. So you're not in such a high risk situation. And then lastly, you could put 100% down and pay all cash. And people go, well, why would you do that? Well, there are certain situations where people will buy into a market because they see, just like we're in now, right? The appreciation is just skyrocketing, right? So you could buy a property now, all cash for $800,000. In a year from now, it could be selling for $950,000. So if you make $150,000 in 1 year, that's a pretty good return as far as on that $800,000 that you invested. Another thing is people pay all cash is people may be coming out of a 1031 exchange where they're in a time crunch and they can't find the exact type of property they want. So temporarily for a year, they may buy in and pay all cash for a property just to be able to avoid the capital gains tax. And that's a much deeper, lengthier conversation. So there are reasons that people do pay 100% in buying investment properties. Okay, so let's talk about your personal retirement plan and how that looks, okay? How your agent and management will lay out your personal plan. Basically, again, comes back. We got to know what your tappable equities are, your cash, and what your IRAs are. Okay. Now, on this here, and you should be able to see this, but if not, I'll go ahead and have you look at this. This is a particular individual that is actual case. He had about $300,000. This is 4 years ago. Okay. And what we decided to do here in this case, we took the $300,000 and this is how we dispersed it. We dropped $20,000 into a checking investment savings account. Okay. We left $44,000 for future real estate accounts or future real estate purchases. Excuse me. Okay, the first property we bought, we put down $80,000. We waited 2 years, and then we bought the second property. He bought it for $156,000. So that dispersed to $300,000. So at this point, he has 2 properties. He has $44,000 setting aside in a future real estate account, and he has $20,000 setting in a check investment savings to run those 2 properties. Okay. So what we would do on your portfolio, we would do basically the same thing. If you have 100 or if you have 500 or 5 million, it doesn't make any difference. We would develop a plan that best suits you based on tappable equities, cash, IRAs, and what is your leverage position and how many years is it going to be until you retire. Okay. So that's how we break it out. So you can see very simply where all the dollars are sitting. Okay. Okay. Now we have to analyze the property. All right. So the first thing, once we set the plan in motion for you, now Tyler and Chrissia, they will actually go out in the marketplace should you choose to work with them or your own agent. Okay. And they will go out and find a piece of property, and they're going to do a market evaluation or a comparable market analysis. So we make sure that you're not overpaying for the property. Okay. So that would be the first thing. The second thing, and this is all before you make an offer on the property. And that's a big advantage you have with this. Second, we're going to do a certified rental analysis, okay? Because we want to know what the real rental rate is. We're not going to look at Zillow. We're not going to look at Realtor.com. We're sure as heck not going to look on Craigslist, okay? All right. And the reason for that is we want to make certain that that number we're giving you is true, because we've done our studies. And most of those properties and those other companies can be as high as 15 to 20% higher than what they actually rent for. Okay. And when I say rent, I'm talking about renting to a qualified resident, that's on a 1-year lease, not somebody that's coming in with no qualification and renting month to month. There's a big difference. That's apples and oranges. Okay. So that's the second thing we got to do. Okay. We got to make sure the rent is spot on. The third thing before we ever make the offer, okay, is we got to see kind of how much is it going to take to make the property rent ready. Okay, so I know it's hard for you to see that, so I made this a little bit bigger here. Okay, so in this particular property, we had a dishwasher is going to need to be replaced. It needed a new carpet. The interior needed to be a complete paint. We had a hall. One of the bathrooms there, we had to go ahead and do some repairs. So about total of $4,500. So now before your agent makes the offer, you know how much approximately it's going to be to make it rent ready. You know what the rental rate is, and you know what the value of the property is. So you're in really good shape going in. Plus, we've got your plan set out. So we know that you're in good shape with your cash and reserves and everything else. Okay. So now not only do you feel good, but we feel good in representing you, knowing, what we have in front of us. Okay. So when we analyze a property, you see a lot of numbers here, right? Well, Chrissy and Tyler will go over that with you. What I'm going to look at here is the big picture. And this is an actual case. This is a property that was bought by our investor about 3.5 years ago. Okay. It was bought in 17, but I believe it was late 17. It was built in 1990. It's a 4-bedroom, 2.5 bath, 17 square feet. It was purchased for $279. The owner put 30% down. He got an interest rate of 4.5%. Pretty good rate, right? Okay. Compared to 1980 when they were 17.5, this is a pretty good rate, ladies and gentlemen. Okay. I know I'm dating myself, but I just come back to this and people kind of go, well, should I buy it? It went up 0.5 point or 1/4 point. I go, oh my gosh, just buy it. It's not going to make any difference in the long term. And I'm going to show you in a second here why you should buy it at 4.5, like he did. Okay. His P&I was $1,008. Total payment, including taxes, insurance, management fee, was $1,547. And it actually, when we projected it, was supposed to be $1,675. Ended up actually renting for $1,850. Okay. And so that's where it was in 2017. And in 2017, everybody goes, oh, I think the market I think it topped out. I don't know. Well, let's take a look. Here's today, ladies and gentlemen. The value of the property is $430,000. It's went up $151,000 in less than 4 years. Okay, not bad, right? On 80,000, okay, he's more than double that. All right. Interest rate was 4.5. He got the rate down to 2.75. In 30 years on that 1.75, he'll save almost $60,000 in interest. 60,000. That's when I talk to people about, a lot of people, they're down at Home Depot trying to manage their own property and save 12 bucks on a faucet. This investor, John, oh no, let somebody else fix the faucet. I'm going to fix my financing. And instead of saving 12 bucks, he just saved $60,000 over the 30-year term. Okay. That is huge. Okay. Payment went from $1,008 to $812. So now you're saving another $2,400 a year as far as on the actual payment itself. And the loan amount was $190. Now it's $182. The resident has reduced the debt on that loan $17,000 in just 4 years. Remember when I talk about reducing the note amount? You forget about that payment reduction of capital, and people kind of, well, I can't use it, so I can't count it. Yes, you do count it. So this gives you an idea. And this was the first property that I bought. And by the way, this is the first investment property this owner ever bought ever. Okay. So this isn't a seasoned investor. This isn't somebody who's been buying properties for 30 years. No, this is somebody right out of the gate. So then about 2 years later, which was part of the plan, is to buy another one. Okay. And this one was on Belacanto in Moreno Valley. Okay. Bought in 19, built in 1997, 2-bath, almost 1,800 square feet. Bought it for $390. This one, he put 40% down. He got another interest rate of 4.375. Payment was $1,168. Total payment was $1,878. Rental rate was $2,249. Okay. So this investor, you can see he wants a little cushion there, right? He doesn't want to have a negative, which is good. He wants to be a little bit more conservative, but he's still aggressive because if he can buy properties every 2 years, he's going to do pretty well. This particular gentleman, I think he's like 38 years old. And so he's going to do quite well, right? Very, very well. Okay. So let's see where he's at now. This is about a year and a half ago. The property has went up $105,000 in less than 2 years. $495 from the $390. So $105,000. Okay. Interest rate. He got that. Guess what? He not only got a 2.75 on the first property, he got it on this property. So on this property over the next 30 years, 1.6, he's going to save an additional $63,000 in interest. So between the two properties, he's going to save $120,000. And this is an investor that is focused on taking care of business, being educated, being knowledgeable, working with his lender, and letting somebody else fix the toilet. I know that sounds oversimplified, and that doesn't mean we don't watch our nickels and dimes. But you got to really put your time where it's going to give you the best ROI. Okay. He dropped his payment again, another couple hundred. So another $2,500 a year. So look at this, ladies and gentlemen, between the first property and this property, he's going to make just on cash flow alone about $4,500 more a year, right? Just on cash flow. Now this resident hasn't been in there that long. He hasn't bought it. So the principal reduction there was only $8,000, but 8 on this one, 17 on the other one, it's $25,000, right? Mm-hmm. So hopefully you guys are starting to see how this just multiplies, as far as very, very quickly. Okay, now let's talk about implementing the plan and setting up your checking investment savings to manage your single family home retirement. Okay, we talked before about having a separate account. I can't express enough. And I know we talk about this, but we will keep talking about it because I found that when people set this up, it makes their life so much easier, ladies and gentlemen. It just becomes a breeze to own rental property. Without it, you're always going to be struggling because you're going to be robbing Peter to pay Paul, meaning you're going to pull it out of your personal checking account to go ahead and do something on the rental property. Okay. If you do it this way, you're not only going to like investing in real estate, you're going to love it. Okay. And you're going to make a ton of money doing it at the same time. Okay. Is there any questions that have come in?
Yeah. We have somebody asking regarding the IRAs. A client has a SEP IRA, hadn't considered transferring into a real estate investment. I believe you mentioned earlier that the funds needed to be put in IRA with an accommodator. Could you go over the process of using IRA funds as a real estate investment?
Yeah, that's a very lengthy conversation. So unfortunately, I can't get into the weeds of that. Okay. But please send Kristen your name and phone number, and I'd be more than happy to have a 15 to 30 minute discussion with you to share with you how all that works. Okay.
Okay.
Thank you. What else? Anything else?
Nope.
Okay, let's go ahead and keep moving here. So let's talk about, if I don't act now, what does it cost me? Okay. All right. Because you can wait, right? Mm-hmm. We can all wait. Okay. But what is it going to cost? Just like the last gentleman on the last couple of properties. Had he waited another 3.5 years, he would be $250,000 poorer, right? Okay. Because that's how much he's made in just 3.5 years, $250,000. Okay. And so, let's talk about this. Now, I don't know how many of you play golf, but I'm going to assume that everybody on the webinar tonight plays golf. And I challenge you, because I want to play golf with each and every one of you. And what we're going to do is, if you're okay with this, we're going to bet 10 cents a hole. And then every hole, we're going to double it. Okay. So the first hole, whoever wins it pays the other person 10 cents. Okay. So now let's go ahead and go to hole number 2. Okay. Hole number 2 is 20 cents. Not a big deal, right? Everybody's playing. Hole 3, it goes to 40 cents. Hole 4, 80 cents. Hole number 5, okay, we're at $1.60. Okay. And at hole number 6, we're at $3.20. And I think at $3.20, everybody on the call tonight, that's not a big deal. Okay. So let's keep going. Okay. Just an innocent little game of golf here, right? Okay. So on the 7th hole, it goes to $6.40. 8th hole, $12.80. And now hole number 9, we're at $25. So now somebody can say, well, it's kind of like I ask people, how much do you bid when you go to Vegas on the blackjack table? And you get everything, but most of it's like $5 or $20, right? Everybody's okay with that. So I would think at this point, everybody's still in the game. Okay. So now we're going to go hole number 10. We're at 51. Hole 11, we're 102. And at hole 12, now we're at 204. So if I beat you on hole 12, you owe me $204. Okay. So how many of you are still in? Okay. I'm going to take that as a yes to everybody. So we're going to continue. All right. So now we go to 13th hole. Now we're talking $400, right? Okay. At 14, we're at $800. Now I think I have probably 80% of your attention. Because if you lose this hole, because I'm good at golf, okay, you lose this hole, okay, you're going to pay me over $800 on just this hole. And keep in mind, we still have 4 holes to go, okay, and you have to stay in it for the whole game, okay. Okay, hole number 15, we're at $1,600, and hole 17, we're at $3,700. Now, I would assume at about this point, I may have one person, maybe 2 left still playing. But most people have probably thrown their club to the side and said, little bit too rich, okay? Hole number 17 is $6,500. So what do you think hole 18 is? Hole 18 is $13,107, okay? What I want to get across here tonight, ladies and gentlemen, is real estate is like compounding interest. If you wait, it will just destroy you, okay? You don't have to buy 15 houses, but you can buy one. or you can buy half a house. Or like I told my staff the other night, buy a quarter of a house with your grandpa and grandma. But at the end of the day, you got to get started, because the real estate compounds. Just like if a house was worth 100 this year and it goes up to 150 next year, if the appreciation rate is still 12%, like it's been this year, you don't make 12% on 100, you make 12% on 150, correct?
Mm-hmm.
And it just keeps going and going and going. So I hope this illustration really, kind of get you off the couch and maybe want to make a phone call to at least have a conversation with Tyler or Chrissy or your own agent, but definitely you want to seriously consider moving forward. Okay, does it work? Well, let's take a look here. All right, and we're going to wind it up here in about 5 minutes, ladies and gentlemen. So just hang in there with us. Mary, she's been with us over 30 years. In fact, I had the pleasure of speaking with her in the office the other day. I hadn't seen her in a number of years, and it was a real joy. But Mary, this property here was on Dome. She originally bought it back in 1987 for $78,000, and today it's valued at over $330,000. Rent started at $500. Today it's over $1,600, and her cash per year here is at $19,000 a year, just on this property alone. And so you can see there's just amazing what a simple single family home can do. Okay, here's another one she bought on Finley. She bought this in 2002. And I want to point out here, you see that she didn't buy them all the same year. Everybody with me?
Mm-hmm.
Okay, this isn't somebody that's on a fast track. So I think a lot of people, they get in real estate, they go, oh, I got to buy one, right? Buy one this year, next year. Sometimes you don't, and you're still going to do fine. This one here, 148,000. It's now with 425. Rent started at 800, is more than doubled, and the equity in this one now is 329. As far as on this, there's a little small mortgage she still has on this one here, and then the third property she bought, Liverpool, that was back in 09. Everybody with me now? It's pretty staggered out. Okay, 91, and now it's for 399,000. This thing just went through the roof. Okay, rent went from 1,250 to 1,850. Her cash is 22,000 a year just on this property alone. Okay, so kind of summary. Her equity in these three is $1,064,000. Her cash flow on this is $62,000, and she still has a small debt of $90,000. Okay, as far as on the one property and stuff. I just want to share with you, 2 years ago, we did analysis on this. Her net gain has been over $200,000 in just 2 years on these three properties. Over $200,000. Okay, and good for Mary. I just love it, the fact she's done so well, and she's been an awesome client, and we just wish her all the best. And she's still looking at other properties. So just so you know, she's still in the game. All right. So lastly, what we need to do, and you can't really read this, but you will get a copy of it. Kristen will be sending it out to everyone. It's a net worth statement. So basically what you're going to do here on the left, your assets, you're going to fill out whatever you have and what the value is, whether it be a car, whether it be a house, whether it be a truck, a ski boat, jet ski, whatever it is, you put over here what the value is. And over here, if you have loans against any of those items, then you put that over there, and then subtract your liabilities from your assets, and that'll give you your net worth. And that way we'll be able to figure out, from this, plus what your taxable equities are, plus as far as what you have in cash, your IRA, et cetera, then we can put a personal plan together for you, and then you will be set to go. And I would recommend, even if you're not ready to buy today, you should at least go through the exercise, okay, of doing this to see where you're at. So see when you can. I've had people come into me and they go, I want to go right now. And I go, you know what? No, I don't think it's a good time right now. I think you need to wait about a year. We need to put a few more things together, and then let's come back into the market. And sometimes people have a hard time with that because they think, well, we just want to sell you something to make a commission or manage your property. Ladies and gentlemen, we've been in this for 36 years. We don't need a deal tomorrow. Okay. We want to do what's best for you guys. Okay. And that's the way we've always operated at Management One. So next month, I'm going to show you how we make the property rent ready and why you need that separate checking savings account, the piggy bank as we call it. And also we'll be going over how we rent the property, because how Management One rents a property is quite a bit different than the way the average management company rents it. First of all, we've got a pipeline of thousands of past residents and current residents that feed us leads every single day. Other people don't have that. They say, well, your competitors, they can't compete on that level because they haven't been around 36 years and done 10,000 properties. So what does that mean to you? That means your house is going to rent faster and it's going to rent for more. Okay. And lately we've been actually have properties coming in at 2,500. We tested the market. We put them up at 2,700 and they've been renting like in 3 or 4 days. So there again, the owner now doesn't even have a management fee because the extra $200 a month we made, we paid our own way. We're getting free property management. So it's awesome. Okay. So any last questions on phase 2 here?
No, we don't have any. We just have Tyler to wrap us up on the rental market.
Okay, Tyler, you're up.
Yeah, so I mean, since we're here on time, I'll make it short and sweet. Overall, the rental market, I mean, as well as the sales, has just been, again, skyrocketing. So kind of consensus is, if you can get in now, you can talk to us about it, or if you have a real estate agent or other avenues, just talk to someone and get started, because it's only going to go up. But what Ron had touched on earlier, and then as well as kind of towards the end here, we don't want to sound like a broken record, but it's really, really important, if you aren't already, to manage your money, and then especially on your rental property. And we're not here to tell you what to do with your money. We're coming at it from a recommendation standpoint, but basically is not stealing from that piggy bank, right? So like Ron had mentioned, set up a separate checking and savings account, super simple, with whoever you bank with already. And anything that has to do with your property, so all the income from it, plus some reserves to start out in it, you can keep in that account. And then everything in terms of repairs, HOA payments, taxes, insurance, mortgage payment, if you have one, anything and everything can be paid out from that account. If you have any more questions, contact your CPA, but it's super crucial that you have that account so you're not stealing from yourself, so to speak, because we never want you to have to pull out from personal savings or getting a loan from someone else to pay for things for your property. We want you to be comfortable, be able to build wealth through that retirement process. And so it's just really important. If you have any more questions on that, reach out to us, talk to your CPA, whatever that looks like, so you have those things in place. So when you do start to create and buy those assets, it's pretty streamlined. You can go to bed at night and you'll be pretty well off. So with that said, if we don't have any more questions, Kristen, Ron, Chrissia, back to everyone else, if anyone has anything to say.
Kristen, we'll turn it back to you. You can tell everybody about next month.
So next month, we will be coming to you on August 18th, same time, same place. And Ron will be showing you, like he mentioned, how to make the property rent ready. And so if you want to get started, you can call Chrissia and Tyler. Their information's right here. You also get a copy of this coming out tomorrow morning, so you can gain the information at that time as well.
Well, we're excited, guys, to have you here tonight, and we're excited about next week. You don't want to miss it. It's going to be awesome, and we can't wait to share more of the things that we have going here at Management One and the real estate offices as well. So have a great night.